Welcome back to Learn SKN, and today we're going to continue looking at our economic syllabus, our CSEC economic syllabus. We are going to pick up at objective 7 in module, let's see, in section 7, so international trade. So we have covered a bunch of topics on trade, and so we're going to pick up from exchange number 7, which is the exchange rate. Right, so before we jump into the exchange rate, make sure you like the video, subscribe to the channel, and hit the notification bell so you know when Learn SKN drops another video, whether it is Econ, POB, MOB, whichever. Alright, so let's just jump into it. So the objective asks us to discuss the concepts, principles, and approaches associated with exchange rates. So factors that influence the level of an exchange rate, fixed, floating, and managed exchange rate regimes, appreciation and depreciation of a currency, revaluation and devaluation, downward and upward adjustment to the value of a currency. So we're going to look at all of those in short order. So first things first, we turn to our textbook, exchange rate. And so you see our flow chart here to show what we're supposed to understand as it relates to exchange rates. So exchange rates, we have to know what appreciation, revaluation, exchange rate itself is, depreciation, devaluation, exchange, fixed exchange rate, floating, manage. And so we're going to chop them down one piece at a time. First things first, exchange rate. Countries of the world engage in international trade. However, each country has its own currency. As countries trade with each other, importers must purchase currency to make payments for the imports. Also, when you visit a foreign country, you must purchase the currency of that country to pay for the hotel, transport, and shopping that you will do. The exchange rate is the rate at which one currency can be exchanged for another currency, right, in the foreign market. It is really the price of a currency in terms of another, of one currency in terms of another. For instance, the Trinidadian and Tobago dollar can be bought on the foreign exchange market at a price of 1 titty equal 16 US cents, or if we reverse that, 1 US dollar equal 6.3 titty, but that's back then when the book was written. I'm pretty sure by now it might have changed, it might have been altered up or down, so that's when the book was written. And so a quick Google search will show us that today the exchange rate for 1 titty dollar to, from 1 US dollar to a titty is 6.78. So if you have 1 US dollar in Trinidad, that should equate to 6.78 titty dollars, right? So that's the exchange rate right there. And so if you look at it again, let's look at our next currency. Let's look at the Jamaican dollar, right? Jamaican dollar. So here we see that 1 US dollar is equal to $153.40 Jamaican. So we see that. So we can see it has been fluctuating over time. And we're going to discuss what this really means. Right? So if you look at the Eastern Caribbean dollar now, XCD, that's the Eastern Caribbean dollar, you'll see that 1 US dollar equal to 2.70 EC dollars, right? And you can see that this line is straight, meaning it's not changing. And later on, we're going to look at that and see why. Why is it that the EC dollar, you see one straight line, ain't changing? Why is it when you look at the Jamaican dollar, we see a whole lot of ups and downs, right? It changes. When we look at the, let's see, the Barbados dollar, where is it? Bajan dollar. That's Bahamian Bajan dollar right here. So 1 US is basically 2 for 1. So 1 US dollar is 2 Bajan dollars, right? And so we're gonna see why. But that's just what we're looking at. We're looking at exchange rate. A quick view at the exchange rate right there. So it's basically what the amount of one currency you can get for another. In a nutshell, the exchange rate. So the exchange rate is the rate at which one currency can be exchanged for another. So in the terms of the EC for the US, you need $2.70 EC to obtain 1 US dollar, right? That's the exchange rate right there. And we saw that you need about 6.7 $TT to get $1. You need about 2 Bayesian dollars to get $1. You need about 150 something, 53 I think it was, Jamaican dollars to get $1. So that's the exchange rate right there. And you can always flip it when you want to. You can either go from US to whatever the currency is, or that currency to whatever the US is. And so if you look at it again, let's look at the EC dollar again. Eastern Caribbean dollar. So the exchange rate, if you have 1 EC dollar, that's only 37 cents US, if you want to put it from that perspective. 1 Eastern Caribbean dollar is equate to 37 US dollars. We look at the same for Jamaica. You have 1 Jamaican dollar, that's 0.0065 of a cent US dollar, right? So it's way less than a cent. But that's just a one way of looking at it. If you go the other way, a dollar, it's 153 Jamaican dollars. So that's the exchange rate in a nutshell. That's what it is. The rate at which one currency exchanges for another. And naturally, you are going to want to exchange currencies, because if I leave an Eastern Caribbean country, go to Jamaica, I need money I can spend on the road. I need money I can pay the taxi. I can't pay the taxi man 1 EC dollar. That don't fly, right? So you have to go and exchange. So you land on the airport or wherever you go and buy some Jamaican dollars, buy some $50, or you can buy US dollars because that's accepted across the region. Not all currencies are accepted everywhere. Like right here where I live, we don't really accept TT or Jamaican or Bayesian dollars. It's either US, Canadian pounds, euros, right? And so you have to go and buy the currency that you require to use. I mean, the greenback or the US dollar is the universal money of doing business. So if I want to buy something, import something from overseas, from America, I have to convert my currency into the US currency, right? So you have to know your exchange rate so you know you don't get robbed when you go somewhere. Somebody tell you, they try to round off or round up whatever the figure and give you some ridiculous price. Sometimes you go to buy a currency, maybe on the grey market, and they want to inflate the value of the currency. Right? So you have to know your exchange rate. And there's so many currencies in the world that you can go on and on looking at the various exchange rates. But you see, Google right here can be your friend. If you go Eastern Caribbean dollar to Jamaican dollar, look at that. So 1 EC dollar equates to 57.76 Jamaican dollar. If you have to do that into Trinidad dollar, $50, 1 EC equates to 2.51 $50. So the Eastern Caribbean dollar is somewhat strong in the Caribbean. It's not as strong as the Bayesian. Bayesian is 1 for 1, 2 for 1, right? So, but it still has significant strength. So you can go across and just mix and match to see what currency the exchange rate for various currency. Let's go. $1 equal to 22 Jamaican dollars, right? So we can do all of that. So that's the exchange rate in a nutshell, the definition, right? You need the exchange rate for a number of things. As I said before, you're traveling, you need to buy the currency. You're doing business, you need to buy the currency. So you need it for a number of reasons. Now the foreign exchange market. Now there's actually a foreign exchange market, or we call it Forex. People actually buy and sell foreign currency to make money. The difference between the buying and selling is how you make your money. For example, not all currencies remain the same in terms of the value. They fluctuate. Just the other day, the pound was almost equal to the US dollar, right? When Liz Truss made her announcement, the pound, went down, because the pound and the US dollar are not really on parity. But sometimes people speculate, they'll buy the pound, sell it at a certain, when it's high, but you buy when it's low, sell when it's high, that kind of thing, right? To make a little extra money in the foreign exchange market. That's why you're buying and selling of different currencies, the foreign exchange market. And so that's something you can invest in. You can buy different currencies, but you have to be aware of factors that might influence the value, so you can be, on top of the curve and be always on top of these things. So whether to buy or sell, hold or whatever these currencies, or should I have open a US account versus maybe a pound account or a euro account, whichever one, a yuan, a yen, a peso. There's so many currencies out there, right? So that's the foreign exchange market where you buy and sell or trade these currencies. In 2009, the prices of a US dollar in the Caribbean country currencies were Bayesian dollar, it was 2 to 1 still. Eastern Caribbean dollar, that has since improved to, well, not improved, but that has moved to 2.70. The Guyana dollar, whoa, 194 back then. Jamaican dollar was 86. So you see how far the Jamaican dollar has fallen in terms of value versus the US dollar, because today 1 US equal to 153 Jamaican dollars. You can see that the value of the Jamaican dollar has fallen since then, right? Because this was 2009, we're in 2022, so a lot has changed since then. So that's just a little synopsis. Now, different countries have different exchange rate systems. As I showed you earlier, when I was looking at the different currencies, you saw the line, right? You saw the difference. Let me show you again, right? Look at this. Let's look at the US versus these different currencies. So 1 United States dollar is worth 153 Jamaican dollar. But look at this graph here, right? It's going up, down, up, down. At one point it was 151. At one point it was 154. It's going up, going down. So you realize it doesn't stay the same. This exchange rate doesn't stay the same, and we're going to tell you why in shortly. It doesn't stay the same. Look at the EC dollar on the other hand, right? Straight line, straight line. It stays the same, straight line. Why? Okay, so let's look at it right now. These are the three main exchange rate systems where countries can use one of those three. You have what we call the fixed exchange rate system, or the fixed exchange rate mechanism, the floating exchange rate mechanism, and we have the managed exchange rate system. So these are the three main exchange rate systems that are out there, right? The main ones. And so a country can choose which one they prefer to use based on various circumstances, whether it is the strength of your economy, whether it is you want to channel certain, imports, exports, however you want to do it based on your economy, what's going to benefit your economy, then you choose that system that best serves that purpose. So the fixed exchange rate system is what we would have in the EC versus the US, because I realize it doesn't change. It's going to remain at 2.71 Eastern Caribbean dollars for 1 US dollar for the longest while, right? It is fixed. It doesn't change. Over time, it doesn't change. It is fixed. From the time the EC dollar was introduced, it was what we call pegged. It was attached or pegged to the US dollar. So it at this particular rate, at a fixed rate, it was connected to the US dollar at a fixed rate, or we call it was pegged to the US dollar at a fixed rate. So no matter what, the EC is going to remain the same as it relates to the exchange rate with the US dollar. And so if the value of the US dollar goes up, then that would impact the Eastern Caribbean dollar value also, right? So this is a good, right now we have inflation going on in the world, and that's why they say, you can look at our inflation video, they said that inflation is imported in the Caribbean because, for example, we require the US dollar. And so if the value of the US goes up, then it affects our currency also, right? So this is a fixed exchange rate system. What is it exactly? You can tell by the name. When the government sets the exchange rate, the rate is said to be fixed. The government, through the central bank, announces a value for the exchange rate. Prior to April 93, Trinidad and Tobago operated under a fixed exchange rate regime. When the rate is fixed, the government can choose to change the rate at any time. If the government makes a downward adjustment of the exchange rate, this is a devaluation of the exchange rate. This means that the domestic currency has become cheaper on the foreign exchange market. But we're looking at that just yet, right? So let's look at this one though. The fixed exchange rate is a rate that is set by the government or the authorities. It's fixed. So the government chooses, or the authorities chooses, what the exchange rate for one currency versus another is going to be. And that's what we call it a fixed exchange rate. Now, if you're looking at the other example here now, the US dollar versus the Jamaican dollar now, right? Look at that. Look at the line again. That is what we call a floating exchange rate. Right here, floating exchange rate. So what is a floating exchange rate? As it suggests, it floats in the market, right? It floats in the market. So it's at the mercy of supply and demand. So under the floating exchange rate system, the forces of supply and demand operates to determine the value of the currency. So in the fixed, the government determines the value of one currency for next. In the floating, the market, supply and demand determines whether the value goes up or down of one currency in exchange for another. And so that's why we have those two right there, the fixed and the floating exchange rate. The fixed is when a government or an authority say, okay, this is the exchange rate for one currency to the next. The floating is where the market determines that. And so at any time you can see going up, down, left, right, as you see in the graph, because it is floating. It is at the whims of the market. The market determines whether it goes up or down. And that's what we call the floating exchange rate. And as you can see here from this diagram, right, the movements can be so wild. It can be way up, way down, right? And so this is what brings us to this third one, we call the managed exchange rate system, where the government wouldn't allow the currency to move to a certain level. It doesn't allow it to go too high or too low. That's what we call managed. So if they find that it's going too, the value of the currency is going too low, they intervene. The government intervenes and bring it back down to a level that they're comfortable with. If it's going too high, again they intervene to bring it back down to a level they're comfortable with. And so when a currency is floating, it can fluctuate considerably from day to day. It can gain value or lose value rapidly over a short period. These fluctuations can cause residents to lose confidence in the currency. They can also hinder international trade, as a currency can change value between the time at which you buy something and the time which time comes to pay for that something. So the government don't want to have this chaotic thing going on right there. The market is too volatile, they don't want the volatility. And so the government may, through the central bank, can intervene in the foreign exchange market to maintain the rate at which the value that they want, the range, right? So they can either jump in and influence the rate of exchange for that particular, those two particular currencies, right? So that is what those three systems entail: the fixed exchange rate, the floating exchange rate, and the managed exchange rate, right? So those are the three major exchange rates. So let's dig into something else, right? Let's dig a little deeper for certain terminologies that we are required to understand. So right here they ask us to speak about revaluation, devaluation, appreciation, depreciation. So let's look at those right there. So what is devaluation versus revaluation? Devaluation, revaluation. Definition time. A devaluation is a downward movement in domestic currency, making the currency cheaper on the foreign exchange market. What does this mean? Remember, we said that the fixed exchange rate is set by the government or the authority. They also have the ability to either bring down the value of the currency or carry up the value of the currency as it relates to exchanging for one currency versus the next. So what this means is that a government might say, let's say in terms of EC dollar. So right now I told you the EC dollar, the exchange rate for US is 1 US equal 2.70 EC dollars. Now the central bank, the Eastern Caribbean Central Bank, can say, okay, let's bring down the value of the EC dollar because it's a little too expensive for foreigners. Nobody wants to buy our products because our currency is too expensive. So how do they do that? If tomorrow the central bank wants to cheapen our currency or devalue it, they would say, okay, from today, the exchange rate for 1 US to EC would be $3. Right? So it's $3 now. So you need $3 EC to get 1 US dollar. Now, I know it might sound counterintuitive because we're saying we devalue the currency, yet the amount going up because we move from $2.70 to $3. But understand this, the value is lower because now you need even more EC to buy the same 1 US dollar. So before you only needed 2.7 to buy 1 US, but now you need whole $3 to buy 1 US. So the value of the currency has gone down. It is now cheaper compared to the US dollar. The same US dollar, the dollar ain't move, but yet you need even more EC dollars to buy the same 1 US dollar. Same way, if they say, okay, the Bayesian dollar, let's move from 2 for 1, so 1 US equal 2 Bayesian to 1 US equal 3 Bayesian. Again, that means the Bayesian dollar has reduced its value. It's been devalued. But please note that devaluation only occurs in a fixed exchange rate system because this is a deliberate movement. The authorities chose to devalue the currency, chose to bring down the value of the currency for whatever reason, right? Whether it is they want to spur exports, because if the currency is cheaper, that means US would come and buy more of our stuff. That means our stuff is cheaper, so the US going to import more because all of a sudden they realize, wait, the same US dollar getting us more of these Caribbean products. And so that might be a goal that the government has. They want to improve exports, so increase exports. So therefore, they bring down the value of the currency because this can help to boost exports, right? Also, this can reduce imports because what this means now is that persons on island, they need more of their local currency to buy things online. So that might deter them from importing more because it's more expensive for them to import. And so that's why they might want to devalue a currency. And then the same thing for revaluing, meaning you increase the power or the value of the currency, you carry it up. So a revaluation is an upward adjustment of the domestic currency, making the currency more expensive on the foreign exchange market. So again, the government might want to increase imports, right? For whatever reason, they might want to increase imports. And so they strengthen the dollar. So now you're going to buy your local currency can reach further, buy more US goods or more foreign goods because it's stronger now, the value is higher. Same way, they may want to reduce exports, right? So what they do is cut the currency and so the exports might reduce. You know, all this is to get the balance of trade and balance of payments in proper order. And so that's revaluation. Again, these two occur in the fixed exchange rate system, the fix, right? So when you get a chance, you can read the textbook and understand. Remember, you can purchase the textbooks in and along with other things in the description. Good. So that's the devaluation and revaluation in a nutshell. So if you're looking at the floating exchange rate now, as I said, the floating exchange rate is one that is controlled by supply and demand, the market forces. And so what can influence the demand for a currency? Things like if foreigners demand domestic currency, they fall under 3 groups: those who wish to buy the exports of the country, those who wish to visit the country, those who wish to invest in the country. So all these would lead them to buying the currency, the demand for the currency. So if you wish to buy more exports, then that would mean that you demand more of the currency. If you wish to visit the country, you buy more of the currency. If you wish to invest in the country, you buy more of the currency. And so that would carry up your demand. So you go back to your supply and demand, and it's the same idea. If you don't want to, let's say people stop visiting Jamaica, stop visiting the Caribbean, then, okay, we're going to use Jamaica because it's floating. If they stop visiting Jamaica, tourists stop coming to Jamaica for whatever reason, then the demand for the currency will go down. And so the value of the currency will go down. Let's say people want to stop buying the goods that Jamaica exports. Demand for the currency gone down, the value of the currency gone down. Let's say a person wish to invest less in Jamaica, same thing, value gone down. And the reverse is also true. If you want more visitors coming to the country, value gone up. You want to invest more in the country, the value goes up. And you want to buy more exports, the value goes up. And then even for us home, the residents, right, we conduct transactions abroad, and so what can influence our demand for the currency? Those who wish to buy imported goods and services, those who wish to visit foreign countries, and those who wish to invest in other countries of the world. So what they're saying is that, let's say I'm living in Jamaica, but I have a taste for foreign goods. What does this mean? I'm going to demand more of the US dollar than the local currency. And so the demand for the US go up, the demand for the local goes down, and so the value of the local goes down. If I want to visit foreign countries, if I take vacation all the time, I don't want to stay in Jamaica and enjoy, a night, a weekend at the Hilton or wherever. Then I want to go outside. Then that means my demand as a resident for the Jamaican dollar goes down because I want the US dollar to travel abroad or the pound to travel abroad. Right? So those are the reasons that would influence the demand and supply for the currencies. Now the two words that we have to look at here now under the floating exchange rate system is depreciation and appreciation. Depreciation and appreciation. Remember, in the fixed, we looked at devaluation and revaluation. In the floating, it's depreciation and appreciation. What is depreciation? That's simply a depreciation of a currency is a fall in the external value of that currency due to changes in the forces of supply and demand. That's depreciation. So they're saying that if for whatever reason nobody wants my currency no more, the demand for my currency drop, and it's in a floating system, then the value of that currency has depreciated. It has gone down. It has depreciated because the demand for that currency gone down, right? Same way, if the supply of the currency goes up, that means the currency all over the place, everybody can get their hands on it, a lot of money on the market, then the value of the currency has dropped, right? So depreciated. When it is supply or demand, the value of the currency has dropped, and so it's called depreciation, right? So just as for any other commodity, as demand falls or supply increases, the currency becomes cheaper. So if you flood the market with Jamaican dollars, the value is, everybody got it, so the value ain't really all that, it depreciates. If you demand less of it, then the value depreciates again. So that's depreciation. And so that would cause the value of the currency to drop when it depreciates. That's why you saw all of these ups and downs. So the downs would be depreciation. The value is falling, it's depreciating. It appreciates when it goes up. So appreciation is about the value of the currency going up. So if everybody wants the currency, it's in high demand, then it would appreciate. The value would rise, it appreciates. But if the supply goes down and the demand goes up, then the value of that currency goes up, and so it appreciates, it becomes stronger, right? And again, I show you here again on the graph. Appreciation is where it goes up, then it depreciates. All of it is at the force, is the market. Supply and demand is what is dictating whether our currency appreciates or depreciates. So if the demand for that currency goes up and the supply goes down, that currency depreciates. The value goes up. If the demand for that currency goes down or the supply goes up, then that currency would have depreciated, and so the value goes down. So right, and I have a table right here that summarizes it nicely. In a fixed exchange rate, devaluate, revaluate. In a floating, is depreciation, appreciation. So you see it right there. The different systems, different names for basically the same thing. Okay, so we now state the general rules. A depreciation is caused by falling demand or rising supply of a country's currency, and appreciation is caused by a rising demand or falling supply of a country's currency. And they are summarized in the table below. The following factors affect the demand and supply of currency and so influence the exchange rate. Again, domestic prices compared to foreign prices. So let's dig into this now. So these are the factors that affect the exchange rate, especially when it is how should I call it? Especially when it is a floating exchange rate. So first up, let's look at the domestic prices compared to foreign prices. So domestic prices compared to foreign prices, that can influence the demand for exchange rate, for currency, right? If local prices are low compared to foreign prices, then residents and foreigners will buy more domestic goods. There will be a currency appreciation. If local prices are high compared to foreign prices, then residents and foreigners will buy more foreign goods. There will be a depreciation of the currency. We looked at it earlier, but let's look at it a little deeper. Hear what it's saying here. Let's say I live in the Caribbean and I want to buy some stuff. Let's say clothing. If the clothing prices here on island are lower compared to if I bring it in, if I order it, I'm gonna buy the local, and so that would cause me to demand more of my local currency, and that would in turn cause the currency to appreciate because I'm demanding more of my local currency. The flip side now, if people find that it's cheaper to import goods, buy foreign goods than local, then that would cause the local currency to depreciate because everybody now want a foreign currency in order to make their purchases overseas. And so that can cause the currency, the local currency, to really depreciate the value because everybody gonna demand more of the foreign currency. So that's why that's how prices would impact the exchange rate, the price both locally and domestically. If domestic prices are cheaper than foreign, then you would want to buy it local. But if they are if it's more expensive, then you might want to go foreign and buy the cheaper stuff because there are some things that even when you import them, pay duty, pay customs, the price still can't reach the level of some of the local products. And so you'll find that you'll demand more of that foreign product than the local, and thus you're demanding more of the foreign currency than the local, and causing the currency to the local one to depreciate, right? Once it's a part of the floating exchange rate system. Then they say here domestic income levels, right? What they're saying here, I mean, this is just like the factors that influence supply and demand, right? So if domestic income levels are increasing, people getting more money in the pocket, what gonna happen? They're gonna start importing more stuff, right? Because they gain a little bit more money, and so the demand for foreign goods goes up, and so the demand for the foreign currency goes up, and the demand for the local currency would go down. And of course, once it goes down, that means we have some depreciation taking place. And then the reverse is also true. If local incomes are low, then people would tend to stick to the domestic market, and so the demand for the domestic currency would be high and the value would appreciate. On the other hand, foreign incomes will reduce the demand for imports and the currency will appreciate, right? Because everybody wants a local one, and so the value goes up. Change in taste. So it's very similar to the factors that influence demand. Change in taste. If all of a sudden you prefer foreign goods, then you would import more foreign goods, and so the demand for the local currency goes down and the demand for the foreign currency goes up. And if the demand for the local currency goes down, then the value would go down, causing it to depreciate. But if you prefer local goods, your taste for local goods gone up or improve, then you're gonna shun the foreign goods, get the domestic currency, and so the demand for the domestic currency goes up, and so that currency would appreciate in value. So if you're looking at the interest rate, right, the interest rate changes. As the interest rates increase and become higher than those of other countries, foreign currencies might flow into the country to take advantage of the high rates of interest. So if you have high interest rates in your country, then foreign currency is going to come in, and this will cause an appreciation because they now have to buy your currency to invest, right? They have to buy your currency now to invest because they want to take advantage of the high interest rate, and so they're gonna buy up the currency to invest because for them, their currency might be able to stretch further, and so they're gonna increase the demand for yours, and that will cause the appreciation. As interest rates fall and become lower than those of other countries, the foreign countries might flow out now because now the returns aren't as high as they could be because interest rates are lower, and so the currency is gonna flow outside of the market, outside of the country, and so the demand for the other currency where they're going, wherever the capital is flowing, wherever it's going, you're gonna demand that currency as opposed to the domestic one. And so that means now that the domestic currency, the demand goes down, and that would cause the currency to depreciate, and so that would influence the exchange rate. And the last factor would be speculation. Remember I told you that there are persons who engage in the foreign exchange market, the forex traders, where they trade currencies. You know, you buy them when their value are low and they sell them when the value are high. So you get the difference between the buying and selling. That's your profit right there. So speculation, like a lot of people would speculate that the pound would move up or down based on what the prime minister might say or do, and so they might invest in more pounds or more dollars or whatever based on what they speculate, based on what they assume. So based on the speculation, that can influence whether you demand more of a currency or the other. And so if speculation leads you to increase the demand for the local currency because you feel as though the local currency might go up in value or something like that, then that would lead to some appreciation of the currency. But if speculation leads you to believe that the value goes down, people are going to start getting rid of the local currency, and so the supply would increase, and so the overall value of that currency goes down, so it would have been devalued. Alright, so that's it for now. That's basically it for exchange rates. That's basically all you need to know as it relates to exchange rates. So you would have covered all of 7 in this video right here. Factors that influence the level of an exchange rate: floating, managed, fixed. We looked at revaluation, devaluation, appreciation, depreciation, adjustment, downward and upward adjustment to the value of the currency. Right, so that's basically it for the exchange rate chapter. So you know what to do now. Like the video, subscribe to the channel, and hit the notification bell so you know when Learn SKN drops another video on CSEC economics. Alright, so thanks for watching and thanks for listening.